Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, we're going to ask ourselves a few questions about banks. What makes them so difficult to understand? Why do we have so many competing theories? And how do they actually work? So you may have heard of some theories such as the loanable funds model or the money multiplier model, or even you might have heard the banks can create deposits essentially out of thin air, that loans create deposits. And so all of these theories are essentially incompatible and they can't all be true at once. One model says that a bank must wait for money or deposits to come in before it can make loans. And the next theory says that actually a bank can wait for deposits or money to come in and then it can multiply up that money, those deposits, and make a multiple of those into loans. And then the third, and I guess final theory, says that a bank actually doesn't need to wait for money or deposits to come in at all. It can essentially create loans out of thin air. It creates a loan and then it creates a deposit. So loans create deposits. And so naturally with these three theories, the question arises, why do we have competing theories about banks? I mean, banks exist. We can ask bank managers or CEOs how banks work. And in fact, when we do that, we find out that it's C. That in fact, banks don't have to wait for deposits to come in before making a loan. They can make a loan independent of waiting for deposits to come in. It's not as if you go into the bank at 9:05 a.m. in the morning to ask for a home loan, and then the bank is like, well, actually, we have to wait until 1 p.m. I have to wait for more deposits or more money to come in before I can make this loan to you. They can actually just assess your financial situation on the spot and then give you a loan. And so with this in mind, the question is, well, what constrains bank lending and where do the other theories of bank lending come from? And so the answer, which might initially seem like a cop-out, which I'll be exploring throughout the course of this video, is that all three are true to an extent. And yet, if banks can essentially create money out of thin air, what keeps the money supply stable? Why can we continue trusting banks? And yet we can find another article which says that actually banks don't create money out of thin air. And so that sort of seems to invalidate what I've just said. So what I'm going to do is I'm going to go to my drawing pad and I'm actually going to explore all of these ideas and I'm going to come up with a sort of a working theory, a working idea of how we can understand how banks, actually work and ultimately what constrains bank lending and what makes banking so stable in the long run. And indeed, what has made banking so stable for centuries before us. And so the video is broken down as such. Firstly, I give an example of lending out money without a bank. And then I do the same example with the bank and using balance sheets and showing how exciting and how cool it is that we can use balance sheets to show how banks work. And don't worry, I go through it very slowly so it's easy to understand. And then I explore the concepts of savers and borrowers and how banks fit into this. And then I have another section on what constrains bank lending. Where do the constraints come from and why do they matter? And then finally, I go into a bit of speculation, or actually quite a lot of speculation, on how money first arises. And if all assets equal liabilities in the economy in the aggregate, where did money arise from and who holds the first liability? Who would want to hold the first liability of money so therefore people can use money as an asset in day-to-day or week-to-week transactions? However, without any further ado, let's go to my tablet and let's get into the video. And here we have our no bank scenario. Here we have you as the saver and you have $3 or 3 coins. It doesn't matter too much, it's 3 of something. But just for the sake of simplicity and for shorthand, say $3. Everyone else in this little economy has $10, and so in the aggregate we have $13. So yeah, you've managed to save up money and you're ready to loan it out. You want a return on this money, and here we have the borrower who has $0. As is the case in such scenarios, just to make it easier, you don't have any particular ideas on how to or what to do with the money, how to spend it necessarily, but you do want to invest it. And the borrower in this situation is an entrepreneur, and in particular, he wants to sell garum. And what is garum, you might ask? Well, it's a dish made from fermented fish guts. And if that sounds absolutely amazing and delightful, well, everyone else here agrees, and so might you. And so you're willing to invest in this business for him to set up a warehouse and a shop front. Warehouse to receive the goods, to store all of the ingredients, and then a shop front, of course, to sell the garum. But he needs money, of course, and you're going to lend him the money. And in doing so, of course, you're going to charge interest. And just for the sake of an easy example, the interest equals $1. And so he has to generate $4 from this business. And all he's going to be doing is selling garum, just to make it easier. So let's do that. Let's cross out the $3 and give that over to him. So now he has $3. And of course, you will note nothing has changed in the aggregate. The aggregate amount in the economy is still $13. So that's all good. And everyone else still has $10. So the borrower gets to work. And of course, he's going to build his fancy shop front, which is going to have 2 doors. It's going to have a portico. Of course, it's going to have a roof. And of course, the warehouse receives all the shipments. And he also gets a bunch of supplies. And you're just going to have to imagine this as amphorae. I think that's how it's pronounced. But basically vases. Yeah, vases with which to store and then sell the garum in. Excuse my drawings. Each one, as we can see, got successfully larger. But either way, this $3 is spent to first get the building constructed, to set up the contracts, all that jazz. We now have a place to store all of the raw ingredients, and now we can actually start selling. And of course, this money actually is spent to everyone else who now has $13, because you're not the one actually doing all of the work. You're just supplying the money, and you're off presumably taking a vacation or something, or you're doing something else with your time. But everyone else, the laborers and all that, they're here, and also the people who are actually going to be supplying him as well. But the $3 is spent, and so $13 now to everyone else. But now he's actually ready to start a business. After maybe a few months, we come down here, and these are for sale. And let's just say, for the sake of simplicity, he makes $3 worth of sales, and that comes from everyone else. They're now enjoying the garum. You certainly can't, because you have $0 to your name. Actually, we should write $0. Just make that explicit. And everyone else spends $3, and that goes to him. That's a pretty good start, because here he can pay back the principal. But that's of course not enough. You're demanding interest of $1. And so he's still got some left over after the $3. So he sells $1 more worth. And that of course comes from everyone else. $9. And that's pretty decent. As a start, he's got this building, he's got all these supplies, and he can pay you back, and he can pay back the interest. But of course, he doesn't want to just get into business to pay back the principal and interest. He wants to make a profit. And so he sells $1 more worth. And we'll just say, just for this, again, for the sake of this example, that's all of his supplies. And that, of course, comes from everyone else. And so we have $8. We now have $5 here. So the aggregate amount is still $13. And we can now actually pay you back. So that's exactly what he does. $3, $1, and that pays you back. So the interest is now paid back, and you have $4. And so now with this excessively simple example, but just to illustrate my point, everyone else has $8, you now have $4, and he has $1. And of course, this $1 is profit. And now we might ask, what is the end result? We've gone through all of this. You've lent out your money, you've demanded interest. He's actually earned the interest and profit. He's got this business. He sold all of his initial supplies. He would actually have to spend this money, or he'd have to borrow more money to get more supplies. And then we have everyone else who used to have $10, now has $8. So what's the end result? Well, first we have our business. Hopefully this shows up well enough on the screen. But we have our business. We have the physical building itself. And we then have this $1. And we sort of might ask, what does this $1 of profit represent? The simple answer to that is that everyone else we can sort of imagine happiness, maybe wealth, they all increased. And specifically, this happiness and this wealth came from the fact that this didn't exist before. It's just something new. And because of this new thing, overall well-being increased. These experiences you couldn't have absent this business starting. And so that's what this $1 profit encapsulates. However, you'll notice that in the aggregate, the amount of money in the economy didn't change. And so we still have $13 despite the fact happiness, wealth, well-being, all of this new stuff, it's all increased. Without this borrower, without this entrepreneur taking a chance, this building wouldn't exist. And yet the aggregate amount of money in the economy hasn't changed. In this sort of no bank scenario, where it's not sort of satisfactory or not quite satisfactory enough, we might say. And at the very minimum, we would say we would want $14 in the economy. We would want an additional dollar in the economy to represent the fact that the economy has grown. Sort of, if we sort of imagine, all the stuff in the economy is sort of here, and then we have the money, $13. We just sort of put, for lack of a better representation, we sort of put an equal sign here. That this amount of stuff here, and the amount of stuff has actually grown. It's bigger. However, we still have $13. It's sort of like they're not equal anymore. We would sort of expect $14. Sort of keeping this simple example in mind, what we're going to do is we're going to go to an example using banks and balance sheets and do a very similar thing. And we'll show how we can sort of show the same thing, but we can also show something a bit more advanced and, a bit more truer to life. And so let's actually do that. And so here we have an example where what I've done is I've actually amalgamated everyone and just made them a saver, just for the sake of this example, rather than separating you and everyone else out. We've got Cool Bank, we have assets, liabilities plus equity, and then we have borrowers. And once again, borrowers have $0, but they have a lot of cool ideas and they're all essentially entrepreneurs. We say this Cool Bank comes along and everyone's going to put their money into the bank. And what I'll just show, just for this example, I won't show it explicitly on the balance sheet, but just sort of as a primer as to how balance sheets work, we might imagine that the bank has a cool building to go along with having its name, and for some reason it also looks exactly the same as the building in the previous example, but this one's fortified. We have two doors, we have a portico, and we'll just say it's worth 20. And balance sheets have to balance, so we have 20 on this side, on the asset side, but we need something on this side, on the sort of liability and equity side. And how are we going to show that? Well, we're going to show that as 20 equity. And now you might ask, why would equity be on the liability side? Well, that's because from the perspective of the bank, this is a liability because this is the money that people, or even one person, has put into the bank. And if the bank ever dissolves, ever shuts down, this money has to be paid out. And so that's why it's a liability of the bank. And so this is the sense in which these balance. And just one final note, I've sort of used 20 and 20 here, but you could sort of imagine this is a minus as well. So you could imagine this is either 20 equals 20, once again they're balancing, or you could say 20, and then we could have a minus 20 here, and then equals 0. And they're balancing out. So you could have a minus on every entry on the liability side. And most of the examples I've seen have it written just as a positive number. So just 20 equals 20 and all balances out. But we don't need to really see that necessarily. We can just sort of keep that in the backs of our minds. The bank, Cool Bank comes along and it's going to pay out interest of 1. And normally you would have it as a percentage, 5 or 10%. But because I'm using an interesting number, 13, I'm not going to have percentages. So you're just going to pay out, this bank is going to pay out 1 and it's going to charge 2 over here. And so of course the bank makes a profit of 1, and that's of course how it's going to stay in business. The savers hearing about this really cool place to store their money, put their money into the bank. And that's pretty good. That's $13 cash on the asset side of this bank, which is pretty cool, not a bad start. However, that doesn't balance out. So we need a corresponding liability. And that, of course, comes in the form of deposits. So you put your money in, everyone puts their money in, and $13 of deposits are created. And those deposits, of course, are a liability of the bank. If someone comes over and demands their money back, well, of course, the bank has to pay that out. And so, of course, the bank doesn't just sit on this money and just think, oh, that's pretty cool. I'm just going to have $13 in cash and $13 deposits on this balance sheet. It does something with it. Now, more specifically, it charges $2 interest and has to pay $1 interest. And so it has to do something with this money. And so we'll say, for the sake of this a simple example, it keeps $3 in cash because it sort of notices people don't come every day and withdraw their money. They only need $3 and they're going to make $10 in loans. So we still have $13, 10, 3 and 10, and then $13 in deposits. People out here don't really necessarily care what their bank does. You know, they hope it's something cool, they hope it's something good, but as long as they're getting their interest, as long as that interest is promised to them and it's going to be honored, then they don't care what happens with this money, what the bank does, how it, organizes its own balance sheet. Now, of course, these loans go out to the borrowers. And, of course, one of the borrowers is going to set up a business selling garum. And we're going to have a bunch of other businesses. Of course, you wouldn't make this a $10 loan to, one person. That would be way too risky. They'd be crazy. But instead, it's going to be diversified. A diversified, healthy portfolio. Now, let's just say the time has come and $2 of interest is going to be paid back. So, of course, how is that shown? We can do it one of two ways. So we can increase, so $2 comes in and we show that as $4 cash. So just, this is the new amount. And then you pay back the $1, or you pay out, the $1 over to the savers. And we show that, we have 14 here now. We have 13, so we show that as 1 in equity. And that's pretty good. $2 came in. And you didn't get to keep the $2. $1, of course, had to be paid out, and $1 of equity. However, we needn't necessarily pay that out, outside of your balance sheet. We can actually do that another way. And so you had $3 in cash, $2 comes in, now you have $5 in cash. We still haven't paid this out. So we had $13 in deposits. Instead of paying it out outside of your balance sheet, we could just increase deposits by 1. And so we have 15 and 15. And so you've expanded both sides of your balance sheet. We have a sense in which instead of having $13 in deposits, we now have $14. Unlike our previous example, the money supply has actually increased by 1. It has actually increased to 14. So that's a sense in which those deposits are money for you. And the bank can do all of these things on its side of this, on this asset side of its balance sheet, and that affects the money supply. In this case, we've paid back interest, the balance sheet that has expanded on both sides, and now we have $14 overall in this economy, because you're the only bank in this economy. However, you will notice that in some sense I've cheated, and that's the sense in which this money has sort of come out of nowhere, in the sense that it sort of came outside of this economy. In the previous example, the interest was paid back and the principal was paid back by everyone else. It was sort of a closed system. Sort of, one arrow here, and then sort of it came back. And we didn't have any actual growth in the money supply, whereas now we do, because once again, I cheated. Before we try to rescue this and show how loans create deposits, what I'll do is, firstly, I'll just do a little bit of erasure just to make it a little bit simpler, but I'll show an example of how we can unwind this balance sheet. We can actually show that should these loans be paid back, we can sort of put an X through here, and we can put plus 10 cash on this side. There's a sense in which we can unwind these operations. And if everyone withdraws all of their money from the bank, if this bank is going to cease to exist, we can sort of, cross everything out, we're left with one cash. The money's gone, and then we just have the profit of the bank left over. And so, of course, we are still shutting down a bank, and people are presumably being let go from their job and etc. However, we still get this idea that the amount of money in the economy didn't balloon, it didn't, go one way or the other, it didn't contract severely. We could sort of undo this, and life can still go on without this bank. But it's very well worth keeping that example in mind as I show how we can rescue the previous example where I was saying, where can this money come from? Where can this sort of interest, the $2 of interest, where can it possibly come from? And how do we rescue this where I was, quote unquote, cheating before? So the bank notices that the people don't always withdraw their money and then put it back into the bank, or they don't, do this very regularly. Occasionally someone needs to withdraw their money and, withdraw a deposit, and then the bank has to lose some cash. However, most people just make payments within the banking system. And so if Bob wants to pay Ali, we can sort of imagine Bob maybe -1, -2, or whatever, and then we just go +1 for Ali. And we can just do this on the liability side of the balance sheet. We don't actually have to move cash around. And even if, let's say, Bob -5, for example, and Ali +5, we don't have to remove all of this cash. All of this can be done on this side. And so we're keeping the money supply of this economy within the balance sheet. And so keeping this in mind, this is where we can create, for example, a to loan, which creates a to deposit. And this is where the money multiplier comes from. We've now created two loans essentially out of thin air, if you will. An entrepreneur comes over to the bank and says, I want to do something else that doesn't exist already. I want to essentially expand the pie. And can I have a loan? And of course, this $5 in cash, you don't necessarily want to turn this into, let's say, 5 loans on this side, because then you have no cash. However, you can just create 2 loans, and you can expand the balance sheet on both sides. Also, even if you did create the loan out of this $5 in cash, what if someone wants $6, a loan for 6? You don't have the cash for it. And so you leave the cash there, you expand both sides of your balance sheet, and once again, you're expanding the money supply. And specifically, it's for a loan. And the reason that loan exists is for that person to spend that money. And the person, the entrepreneur, doesn't withdraw their money, doesn't withdraw this deposit. They'll do the same thing. If they have a deposit of 2 and they want to spend it, we can -2 here and then add 2 somewhere up here to someone else. And that's the sense in which that interest can be paid back. This person starts a business, they make some sales, they make some money, but in doing so, in starting their business, they've spent the money. Perhaps that money has gone to one of these or a group of these people, maybe amongst all of them, and that is how they pay back the loan. Sorry, that's how they pay back the interest. That's where this $2 of interest can come from. And so, of course, what the bank has done now, it has created credit. This credit is not backed by this original money. And that's why I was saying, keep the previous example in mind. We can't simply undo this bank. If everyone withdraws all of their money, we still have this credit. All of this can disappear. We can still have one equity, $1 in cash, no loans, no deposits. Everyone can withdraw it. This will still be left over. This is your credit, because credit supply goes up and then credit supply goes down when it's no longer needed. And in this case, there's a sense in which the bank cannot so easily be shut down. So previously the bank could shut down and the money supply in the economy would essentially remain the same. All of the savers went in with $13 and they were able to withdraw their money, and so they had $13, and so we didn't have a collapse in the money supply. However, in this case, we have these deposits as the money supply, we have 16. If all of this gets withdrawn, everyone withdraws their money, we have one equity, we have 2 deposits, we have 2 loans, and we have 1 cash left over. This cannot be withdrawn because there's actually no cash here. There's just this 2 loan, there's this credit, and this credit can't be withdrawn because there's no money to back it up. And so that's the sense in which the bank must now keep operating. It will continue to create loans. It will continue to create new deposits. And that will help pay the interest on this loan, for example. And interest from this loan or this deposit can then come back and eventually pay back the interest that's required for this loan. And so once again, we're constantly expanding and contracting the balance sheet as loans are being paid off, money or credit is being extinguished. And that's because that's the needs of the economy. Before the entrepreneur came over and borrowed this $2, should put a dollar sign here, there was no need for this credit to exist. However, he had a brand new idea, you believed in him, and you lent him this money. And that's the same thing all the way down your balance sheet. The loans and the deposits, they're created because that's what the economy needs. And it's now constant. The bank must keep doing this. And the money supply will keep changing, keep going up, keep going down, or I should be more specific, the credit supply keeps going up, keeps going up, and keeps going down. And that will continue so long as the economy continues. If the economy goes through a bad time, the bank will go through a bad time. If the bank goes through a bad time, there's a very real possibility that the economy will also go through a bad time. So before discussing 3 questions which arise from this scenario, we should make it explicit. When this loan is paid back, it's deleted from both sides of your balance sheet. You of course keep the interest, and you'll pay out interest over here, or you will increase deposits, but this loan is paid back, this deposit, this liability disappears, and the money supply contracts. And so if that credit has disappeared, new credit can only be created for more loans, more deposits. And this is a continual cycle. And this loan and this deposit is paid off, etc., etc. And it just keeps on going. However, there are 3 basic and yet important questions that arise from these 2 scenarios which I've now laid out. Number 1, why do the concepts of savers and borrowers even exist? And no, really, I do mean that. It's such a banal question, and yet, why do we have these concepts? We can do what we want with credit, and presumably we want maximum freedom for human societies. We invent essentially all of the concepts that exist. And so yet, why do we have this idea where savers have their money and they sort of want to do something with their money, and then borrowers have nothing, and then they have to earn interest, they have to work really hard to earn obviously the principal, but also interest. And then of course banks step into the picture. But why do these concepts even exist on their own? And why have savers and borrowers always existed? So that's question number 1. Question number 2, what disciplines bank lending? And by that, I mean, if banks can create loans and can create deposits, they can expand both sides of the balance sheet and therefore expand the money supply for everyone. Why don't we get massive booms, massive busts all the time? Why don't we have constant periods where we're in deflation and hyperinflation, or simply just inflation? What keeps things steady? That's the second question. And the third question is a speculative one. It's the question of, where does the original liability come from? Where does money originally come from? In all of my examples, I showed $13, and I sort of had that as a given. But where does that come from? Who holds this liability? It's an asset for everyone that uses it, but as I've shown, assets equals liabilities, and so someone holds that, or a group of people holds that liability. Where does that original liability come from? And like I said, this is speculation. But because it is speculation, I've saved that for last. But let's answer this first question first. Why does the concept of savers and borrowers even exist? Here we can imagine this original town or original tribe of people. Perhaps these people are living in a town half a year, and perhaps they're hunting and gathering the other half. But we can sort of imagine this frontier out here, and this is all the possible things that we can do, at the very least comfortably. If we sort of imagine maybe axes, something arbitrary like this, and we can sort of imagine we can gather food up to this point, and maybe we can construct maybe a dwelling or a religious building or some sort of important dwelling here. Or maybe we can collect food all the way up to here, but then only this time is left to construct something. You might imagine something perhaps a little bit more realistic, perhaps. Maybe the line for food goes out like this. maybe we construct something, and maybe this is leisure. And maybe you can imagine something like cave paintings or some sort of other activities not directly related to our survival can go here. But then we have this line out here, and this represents the absolute limit of technology and our energy. However, we can get there if we work really, really, really hard. We can sort of imagine maybe we can hunt really, 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 really well if we're successful, and we can reach a point out here. We can gain this much extra food. However, it's a big risk. This is all a risky zone. And you can sort of imagine that this is where you lightly jog, or it's a jog that's easy enough for you. However, you can really push hard and you can really sprint. However, that's a risk in that, of course, you'll use more energy, but also this being the times back when we were on the savannah, you could also injure yourself. There are no carefully manicured parks or really easy to traverse paths or anything like that. We don't really step into here because if something goes wrong out here, it's bad for everyone. If things go wrong out here, it's manageable, or I should say in here. All risk within here is much, much more manageable. Out here, something goes wrong and it's much worse for people. And so your original borrower, they have this idea that they want to sell garum. They want to construct this building. And people have constructed buildings in the past, but to sell this garum, it actually requires a more complicated, more complex building, and it's going to require more people than would normally be required to build anything within this zone. It's out here, it's in this risk zone. But they still want to do it. And in doing so, they'll push out the boundaries, they'll make everyone wealthier in this town. And so you can sort of imagine there's all of these activities we can do, but this person, since they want to go out here, this risky zone, we're actually going to give up a number of activities, perhaps free time, perhaps we're going to have to spend more time hunting and gathering, and we're going to have to get good at storing food. We're going to have to save up food, savings, in order to achieve this zone out here. It's going to require a lot more effort. We're going to have to go further afield than we normally would. Maybe there's stones that we can collect that we have to go further out for. And this all can only be done because of these savings that we have, this food that we've saved up. Perhaps we've got a few materials that we can start with before we go further out. And so there's these things we're going to give up in order to achieve this goal, this entrepreneur's dream. And yes, that's exciting for people that we can push the frontier out. However, people are not just going to go into this risk zone willy-nilly and just do it on a whim. People are going to demand something in return. They're going to charge interest. And so that's where this concept of interest comes from. Yes, we will get, if assuming everything goes well, we will get growth, but people want a slice of that growth. So we might imagine this is interest, and maybe this is the profit that's left over for the entrepreneur. He gets something for taking a risk. And the point here is a fairly subtle and yet powerful one. These savings, and I haven't explicitly said it, but we can just represent those savings as money. And if this person had savings that they could then spend on a business, that business or that building can only ever exist within this comfortable zone. Those savings can cover anything within here. And the point being, because he wants to jump outside of this zone, he automatically becomes a borrower. He doesn't have the savings to go into this zone. If he already had the money, he would exist already within this zone. But he wants to push, he wants to go further, and so he becomes a borrower. And that's where these savings come in. They help fund this borrower. And that's the sense in which he can go into this zone. So we have people who are risk averse, and they stay within this zone, and that's why they're savers, and they're looking for something to do with their money. But if their money is to grow, it can only grow within this zone. And the only people willing to step into this zone, they're entrepreneurs, they're borrowers, and they don't have the money. And so that's the sense in which savings and this money helps fund new activities. And that's the sense in which we get savers who are relatively safe and stay within this zone. That's what their money does. They want to take a risk, they want to earn money, However, they don't want to do it themselves. They want someone else to do it. So they lend their money out, or a bank does it. And a bank exists entirely within this zone. And an entrepreneur, a borrower who has nothing, as in the examples I've given, $0, or who has very little money or not enough money to get into this zone, they can borrow this money and then we can get into this new zone. And then the money supply increases specifically because we're now in a new zone. And so to quantify it, for example, we could say $5 previously, we get into this new zone and it's $7, and that $7 represents the fact that someone took a risk, it succeeded, it paid off, and now we have $7. We have new possibilities. And then this line becomes dotted, and we have a new technological frontier. And if someone wants to come out to this zone, for example, then this $7 does not cover them to get out to here. And they once again, they become borrowers. They are the borrowers that want to get into this zone and they're going to take new risks, etc. And so I've mentioned banks here, how they sit within the sort of what you might call a safe zone and then the outer zone with this area of risk. So what constrains bank lending? Let's go into another layer and find out. All right, so here we have the question, what keeps banks in check? And we have three banks. We have imaginatively titled Bank A, Bank B, and now we have a central bank. We'll of course put our $13 of cash here, and here that we can see that, well, I'm also not going to bother showing the liability side of the banks here. We can sort of imagine these things here, but we don't, for the sake of this example, we don't care what these are. But we have $13 of cash here, and that's a liability of the central bank. It owns that money, and being a liability of the central bank, it's called high-powered money. And this money, this liability is the top of the pyramid, and a deposit, if I wrote deposits here, that's next in line. It's not quite as good as high-powered money. It's not as good as sort of the top of the pyramid, but it's close. And for the rest of us, for you and I, it's good enough. And then we have Bank B, which has nothing. And so loans create deposits. And then we have deposits here. Let's just say, just for the sake of putting a number in, 2. So of course the system is out of balance now. And actually, before we consider these two loans, we have assets still equal liabilities because we have 13 of assets here and we have 13 of liabilities. So in the entire system, assets still equal liabilities. However, this bank has originated a loan and it has this as its asset. And what is backing this loan? What stops infinite loans from being created and infinite deposits? Well, it needs to get reserves. This needs to be covered by something, and it can't be this cash. This central bank can't just create, if we're talking about literal cash, it can't create that, but it can create reserves. And so this bank is able to borrow reserves from the central bank. The central bank is allowed to create new reserves and it expanded its own balance sheet in response to this bank expanding its own balance sheet. And these reserves, they become credit because these two loans are created, these deposits, so loans still equal deposits, and this is new credit for the economy. And the central bank controls these reserves and they're a closed system. We can sort of imagine a circle around all of this. If I just quickly draw this circle, this system is a closed system. So the fact that we have these two reserves here, that covers these two loans, and that then is still assets, still equal liabilities overall in the economy. And so having removed that circle and keeping in mind that this is enclosed, it's an enclosed system, it's a system that the central bank controls. It can create these reserves, it can destroy reserves, but it also controls the price of these reserves. And so the only reason this bank was able to originate this loan was because it knew the price of reserves beforehand. And it originated this loan specifically because it saw an opportunity in the economy to do so. Someone or a group of people came to the bank, or perhaps the bank went to those group of people, who knows? And there's going to be growth that's going to happen in the economy, and that growth is going to pay back these reserves. And so initially, when this bank creates these two loans and these deposits, it is in deficit. If at the end of the day it still remains a deficit bank, it has to come up with this interest somehow. And so what it can do, it can borrow that from bank A. And so if we say, just for the sake of example, that interest is 1, we can go 12, and then we can go 1 cash on this side. And that's the sense in which this cash, the money that was deposited into this bank, that's your surplus bank. And that covers this bank for borrowing these reserves. It's created credit, but it can do that because there are already savings in the system. There's already aggregate savings. In this example, the only bank that has savings is Bank A, and so that represents aggregate savings. And so yes, this bank was able to originate these two loans and was able to increase the money supply or the supply of credit. However, there's a sense in which it could only do so because of the aggregate amount of savings that already existed in this bank. We can imagine another scenario. We'll just undo this. And in this other scenario, we can imagine that throughout the day, someone maybe deposits $2 cash into this bank, and that covers them for this loan. But that's part of aggregate savings. Let's say instead of this $13 of cash existing here, and we can say even that people withdrew their cash from Bank A, and cash went down to 11 because someone withdrew it, and someone inserted their cash into Bank B. Perhaps Bank B is better than Bank A, or offers better returns, or it's more enticing somehow. And that's the sense in which, in the aggregate, banks can only create loans from savings that already exist. But we can imagine an even simpler example without any numbers involved. Let's say at the end of the day, this bank is a deficit bank and this is a surplus bank. Yes, this bank can borrow from the central bank. However, the central bank charges a high interest rate called the discount window. And that's the case for Bank B. It can borrow these reserves at this high discount window. And this bank also has surplus reserves it does not need, and it wants to earn an interest on these reserves. And so it can actually lend to the central bank and earn interest. However, that interest is down here. That's the interest at which the central bank is willing to pay interest if you lend the central bank. Essentially, you're lending the central bank its own reserves. It's all still on the liability side of its balance sheet. But we have these 2 points here. And just for the sake of example, you could say this is 3%, this is 1%. This bank can actually borrow from Bank A, and instead of being charged 3%, we can imagine there's something in between. And we can imagine that's 2%. And 2% is better for Bank A than 1%, and 2% is better for Bank B than 3%. And so this is where we get our corridor system of interest rates. And ultimately, it's still a system that the central bank controls. And this is where we get the price of reserves. And this is ultimately one thing which disciplines the system. It's what stops loans being created forever. This deficit bank cannot remain in deficit after the end of the day. It must find reserves. And so we're going to find an equilibrium between these two, whereby the surplus reserves are lent to the Bank B, and that covers Bank B for any loans that are created. If it's too easy for banks to be in deficit and to create new loans, and this is going to cause problems for the economy, the central bank can raise this rate, and that will pull up both of these rates and make borrowing from the central bank more expensive, at which point you have to rely on other banks. However, if those other banks don't have enough surplus, then you don't become a deficit bank. You don't create new loans in the first place. And it's not just the case that at the end of the day, Bank B is super surprised that no other bank, for example, Bank A, has enough surplus reserves for it to borrow. It finds that out. These are correspondent banks. They're in constant communication. And so they know the reserve situation between other banks. And we can sort of imagine, other balance sheets out here, these being other banks, maybe Bank C, D, and E. And if Bank A doesn't have surplus, maybe Bank C does, maybe Bank D does, and if not those, maybe Bank E. And so how cool is it, the fact that the central bank, in controlling this reserve system, which stays within the banking system and the banks must be part of, they must have access to these reserves in order to create money. And that is how the central bank controls the amount of money in the economy and why we don't get sudden bouts of deflation and sudden bouts of inflation. But let's go on to the final point. Let's speculate about the origin of money and the origin of the original liability of money. And so to finish up this video with, let's go into some speculation. Originally with your own group of people, perhaps this is an extended family, perhaps this is a bigger social group, maybe a few hundred. It's a very cohesive group and everyone knows everyone. Therefore, you don't use money amongst each other. You just use a system of credit. And everyone remembers what everyone owes. And so you might do a favor for someone and you'll expect something in return. And this system plays on as someone else does a favor for you and you owe them something. And you essentially have what you might call a shared ledger. And once again, that's a balance sheet. And things go here, and people are constantly doing favors or doing things or doing something for each other, and that keeps the system in check. Or at the very least, that sort of keeps everything going. And there are, of course, strong societal norms in play which compel people to sort of pay back their debts, or at the very least, do things to sort of stay within this social group. And part of that might be paying back their debts or doing nice deeds or essentially just doing anything which perpetuates this group. And by way of visual example, you can sort of imagine credit gets expanded, and then as people do activities and sort of pay people back, credit gets contracted. And things go up and down as required. And once again, this is a shared ledger for everyone. And this is important because you know everyone. However, there are others. And if there's any sort of trade between the groups, that is not done with credit. I'll actually remove this to make it easier to see. All of these norms and all of these things that shape our behaviors, all sorts of rules and etc. that apply to this group, apply to your group, do not apply to them. They have their own set of norms and own set of rules, and they might be similar. However, between yourselves, if you're going to trade, you're not going to use credit. If you have something that they want, you're not going to just sort of give it to them on credit and sort of trust that eventually someone or the entire group is going to pay you back. You're going to want to settle that immediately. And I'm putting it here specifically because this might be one origin for money. And the cool thing here is that we don't need to invoke a state or some sort of government in order for money to exist. It can simply be created as a necessity for trading with others. And more specifically, you might only trade with this group, once or twice a year. And so there's this sense in which things must be settled now. And that is where your money comes in. And you can sort of imagine there's communication between the groups and there's an agreed upon location that everyone meets and also agreed upon prices. And so this money exchanges hands in order to facilitate this trade. They have something you want that you can't get, and you have something that they want and they can't get. This money ultimately, if you imagine a balance sheet, it exists as your liability in the same way that money is created and it exists as their liability. And there's a sense in which your money goes from this liability side of the balance sheet and goes over to their asset side of the balance sheet, and their money comes over to your asset side of the balance sheet. And this money is a shared liability. No one in particular owns this liability. It's a liability for this group. However, it's an asset for this group, and their liability is your asset. And so assets still equals liability in this. If we consider these two groups, your two groups as the world as a whole, assets still equal liabilities. However, we can hone in even further and speculate even further. So now we just have this balance sheet, and this is everyone. And money exists as a liability. We've created it purely for trade. However, let's forget about this other group and let's focus just on this society here, this group of well-connected individuals that know each other. Let's say it keeps growing. It went from a few hundred now to, let's say, 10,000. Now it's not possible to know 10,000 people really, really well. And it's very difficult to use a credit system with 10,000 people or between 10,000 people. So this money exists and it's being used maybe once or twice a year with the other group. However, it still exists and it's still a liability of everyone. But perhaps at one point, instead of everyone, an elite is born. And they essentially take control of the money supply. This money, this original money, becomes the provenance or in control of the elite. In this new town of 10,000, you're going to start using money more often because you can't use a credit system with everyone. You as an individual can't create new money that others are going to accept as payment. You can create credit and you can do that amongst your close group of peers. However, we can sort of imagine you over here. You use money, and so then money becomes your asset. And so this money is sort of the top of the pyramid, if you will, and you're using this money as an asset. It's a liability here, it's an asset here, and then this is you. You spend this money, it becomes their liability, becomes your spending, your purchasing power, and this is why it's on your asset. And so if we imagine, from my earlier examples, the $13, we can imagine a bunch of other people with balance sheets, and maybe you have access to $3. This $13, this original liability, is firstly from the whole group creating money out of thin air for use within another group. However, now that we're going to use money on a more regular basis, perhaps on a daily basis, we can imagine a sort of elite at the top. Now, what sort of elite? Maybe it's a military elite, maybe it's a religious elite. It need not necessarily be a king or something like that, but some group of people, they now control the money supply. They're saying what money is, or maybe they simply took over all the money that was originally created and it's their liability and it becomes your asset. And indeed, everyone else's asset. It's only because we have to interact with strangers on a daily basis. And that is how this original money, so long as it's still used as money by everyone and it's still accepted as a means of payment, it's going to perpetually remain a liability of the elite. The individual people who form part of the elite, they will change over time. Some people will come in, maybe some people will fall out of favor, and they'll go out, and maybe some will come in, go out, etc. Whatever this group of elite is, it's their liability. It remains their liability. And in the modern day, you can imagine, instead of elites, you can imagine this is a central bank. And that's why it remains a liability. And that's why they're at the top. They're sort of at the top of the pyramid. And so you can sort of imagine this is now, they can expand, they can create new money. So long as people want more money in the economy, the elite, they can expand, and this can be credit. That's not the original money. However, it's new credit in the economy, and we still use it as money. That credit, which is a liability of the elite, that credit then comes over here. And I'm separating it out here just by way of example, but it's still money. Whether it's the original money or whether it's credit that the elite have expanded, that is still money. And that's the sense in which loans create deposits, and deposits are money. And so I hope this was a useful bit of speculation on the ultimate origin of money and ultimately who holds the liability and a possible path for where the original liability for money came from that doesn't involve a state or a king or an emperor or what have you. And so I hope you found that video as informative and as interesting as I found to make it. This is something I'm extremely passionate about, and I hope that really shone through in the video. And ultimately, I hope I've explained how and why banking can be so hard to understand. And I hope that I've demystified it, and so that you can keep a mental model in your head when thinking about banking or thinking about money or credit or anything related to the subject. But that's the end of the video. If you have any questions, don't hesitate to ask down below and I'll do my best to answer. Or at the very least, I'll collect the questions and answer them in a follow-up video. But if you wouldn't mind subscribing to my video, that would be absolutely amazing. If you wouldn't mind sharing my videos, that would also be amazing. So eventually I can start earning money from my videos. And in a third-hand sense, you can also be very proud, or you can feel happy for me, because that would be awesome for, I guess, both of us. But thank you for watching until the end of the video, and hope to see you guys in the next video.